The year is 1531. Imagine the bustling port city of Antwerp, a major hub in the European trade network. Merchants gather in the shadow of grand guild halls, their hands filled with goods from distant lands. Spices from the east, silks from the Orient, and silver from the Americas all flow through this vibrant marketplace. Amidst the haggling and bartering, a new kind of exchange is taking shape. Rather than trading tangible goods, merchants are beginning to trade something more abstract: shares in trading voyages. These early stocks represented a stake in the potential profits and losses of a ship's journey. It was a risky proposition. Pirates prowled the seas, storms could sink even the sturdiest vessels, and the success or failure of a voyage often hinged on unpredictable factors. Yet, this early form of stock trading offered investors a chance to diversify their wealth and share in the rewards of global commerce. The Antwerp Bourse, established in 1531, became a central meeting place for these transactions. It was a precursor to the modern stock exchanges we know today, a place where the pulse of international trade could be felt in every transaction. This innovative approach to finance didn't remain confined to Antwerp. Across the Alps, in the canals of Venice, a similar system was developing. Venetian merchants, renowned for their seafaring prowess, also embraced the concept of shared risk and reward. They financed their ambitious voyages through the sale of prestiti, early forms of government bonds, further demonstrating the growing sophistication of European finance. Fast forward a century to the Dutch Golden Age, a time of unprecedented economic power for the Netherlands. In 1602, the Dutch East India Company, or VOC, was established, forever altering the landscape of global trade and finance. The VOC was not merely a trading company, it was a powerful entity with the authority to wage war, establish colonies, and mint its own currency. To finance its ambitious ventures, the VOC turned to the public, issuing shares that granted investors ownership in the company. These shares, traded on the Amsterdam Stock Exchange, represented a revolutionary concept: the modern publicly traded company. Investors, large and small, could now own a piece of the VOC and share in its vast profits from spice trade routes and colonial holdings. The VOC's success fueled a frenzy of investment. Coffee houses in Amsterdam buzzed with traders exchanging shares, analyzing market trends, and speculating on the company's fortunes. The Dutch had created the world's first true stock market, a dynamic system that connected investors with opportunities in far-flung corners of the globe. However, this early market was not without its perils. The tulip mania of the 1630s, a speculative bubble driven by the price of tulip bulbs, serves as a cautionary tale. When the bubble burst, investors learned a harsh lesson about the dangers of market speculation and the importance of sound investment principles. Across the Atlantic, a new nation was taking shape. In the aftermath of the American Revolution, a group of merchants and financiers gathered under a buttonwood tree on Wall Street in New York City. Their goal, to establish a formal system for trading securities in the fledgling United States. This informal agreement, signed in 1792, marked the birth of the New York Stock Exchange, or NYSE. The NYSE quickly became the epicenter of American finance, facilitating the flow of capital that fueled the nation's westward expansion and industrial growth. Railroads, steel mills, and oil companies all turned to the NYSE to raise capital, issuing stocks and bonds that financed their ambitious projects. As the US economy grew, so too did the NYSE. The invention of the telegraph in the mid-19th century revolutionized communication, allowing for near instantaneous transmission of stock prices and trading information. The ticker tape, introduced in 1867, further transformed the market, providing a real-time stream of stock symbols and prices that captivated investors and the public alike. The NYSE's growth mirrored the rise of the United States as an economic powerhouse. It became a symbol of American capitalism, a place where fortunes were made and lost, and where the dreams of entrepreneurs were financed by the investments of millions. In 1896, amidst the rapid industrialization of the Gilded Age, a financial journalist named Charles Dow created a new tool for measuring the stock market's performance: the Dow Jones Industrial Average, or DJIA. Initially comprising just 12 stocks, the DJIA aimed to provide a snapshot of the overall health of the market by tracking the performance of key industrial companies. The DJIA quickly gained prominence as a benchmark for investors and a barometer of the US economy. Its daily fluctuations were followed closely by newspapers and investors alike, becoming a shorthand for the market's overall direction. The creation of the DJIA marked a significant step towards making the stock market more accessible and understandable to the average person. As the 20th century dawned, the DJIA reflected the dynamism and volatility of the American economy. It soared during the Roaring Twenties, a period of unprecedented economic expansion fueled by technological innovation and speculative fervor. However, the DJIA's meteoric rise would soon be followed by an equally dramatic fall.